Today we're going to talk about Chapter 5, which is Accounting for Merchandising Businesses. In the past 4 chapters, we've gone through a regular accounting cycle using a service business as our example. So now we're going to show you how to do the accounting for an actual merchandising business. Remember in Chapter 1, we introduced the 3 different types of businesses: service businesses, merchandising businesses, and manufacturing businesses. Service and merchandising businesses will be covered in Accounting 120, and then manufacturing businesses are covered in Accounting 121. So this chapter has a total of 5 objectives, but we are only going to cover or focus on the first 4. Objective 1 says distinguish between the activities and financial statements of a service and a merchandising business. So what we're going to do is we're going to show you kind of the differences between the two using the information that you should already know, which is a service business. So service businesses have fees earned, and then they have operating expenses. That's what we've looked at in the previous 4 chapters. And we subtract those two to come up with a net income. The difference is with a merchandising business, we have sales, which is our revenue account, like our fees earned account, but then we want to separate out our cost of merchandise sold. Okay, and we separate the two because cost of merchandise sold is one of the, or usually is the largest expense of a merchandising business. So by separating it out, we kind of give our shareholders a little bit more information. And then when we subtract that, we end up with a gross profit, and then we take our regular other operating expenses and subtract those to get net income. Okay, so when the merchandise is sold, the revenue is reported as sales, like I said earlier, and then the cost of that merchandise, what it cost the business to originally buy it, is our cost of merchandise sold, and that is an expense account. And so from previous chapters, you should know that all expense accounts have a normal debit balance. So it looks a little bit like this. That's our cost of merchandise sold. When we subtract it from our revenue account, we end up with gross profit. Okay, then we take our gross profit and we subtract out our regular operating expenses to get net income. Then any merchandise that we have still on hand at the end of the year that we have not sold is kept in our merchandise inventory account, and that would be found on our balance sheet because it's considered an asset. So any merchandise that has not been sold is considered an asset to the company. All right, objective 2 is describe and illustrate the accounting for a merchandising business. Objective 2 is the largest objective in this chapter with the most amount of information, so this would be where I would recommend that you focus the majority of your efforts in this objective. Okay, so merchandise inventory, we have 2 different ways that we can account for the inventory. We can do it with a periodic inventory system, which I would say only about 10% of the businesses use this, and usually only small businesses like my mom, who might sell Mary Kay out from her home. She would use a periodic inventory system. So what she does is every year, at the end of the year, she counts what she has on hand, and that's how she takes that's how she controls her inventory. The most common type that is now used is called perpetual inventory system, and this is the inventory system that we are going to assume throughout the rest of this chapter. This is an inventory system. Anybody who uses electronic, when they scan a barcode, then you can assume that they're using a perpetual inventory system. So essentially every time they scan that barcode, it's updating their accounting system and letting them know how many units they have on hand. So we first start out with a business has to first buy inventory to put out on the shelves. So if you'll look in your book in Objective 2, you can follow along with these. So we have 2 ways that we can buy merchandise. We can buy it for cash, or we can buy it on account. So when we buy the inventory, it is an asset, so we debit our asset and we reduce our cash with a credit. Or we will put it on account, meaning we haven't paid for it yet. So that increases our liabilities, accounts payable, and liabilities are increased with a credit as well. So now Net Solutions has some inventory out on the shelves to sell to their customers. Okay, so this is the invoice that we received from Alpha Technologies when we bought the inventory. Okay, there's a couple of things on an invoice that we really need to point out. Okay, first thing are the terms. Okay, the terms. Terms are 210 net 30, and what that means is a 2% discount if you pay the invoice within 10 days. If not, then the net amount is due within 30 days. Okay, so the discount period, the 10 days, starts on the invoice date, which is listed here as well. Okay, so if we look at Exhibit 2 in your book, it breaks out this information. So the invoice date was January 5th. 10 days from that, if you pay within this time period, you get a 2% discount. And if you'll notice, they calculated if the 2% discount is taken, then all Net Solutions has to pay is this $29.40. If they decide to not pay within the 10 days, then they've got 30 days from the invoice date. So 30 days from the invoice date is January 4th, and if they pay within that time period, they have to pay the full invoice amount of $3,000. Okay, so 2% discount within 10 days. If not, the net amount is due in 30. All right, so if we take that discount, what happens is we've got a purchase discount. Okay, so they may receive the discount for early payment, and if we do that, then it'll look like this. Okay, this is when we bought the merchandise. Okay, we bought the merchandise on January 5th. We increased our inventory, and we increased our liabilities by $3,000. Okay, so now we're going to take the discount. So we decide to pay on the 15th, that 10th day. So we need to reduce the amount that we owe Alpha Technologies. So we debit our accounts payable for $3,000, but we're only writing the check for the $2,940. So the difference between the two, or that 2% discount, is an actual reduction in the value of our inventory. So we reduce our inventory by $60, or that 2% discount. Okay, so if we did not take the discount, if we paid 30 days later on February 4th, it would be a simple entry of reducing our accounts payable and writing a check for $3,000, which was the amount of the original invoice. Next thing that we can have is purchase returns and allowances. A lot of times this happens is if a customer, or if us as the business decides to return something that we purchased, or if the company decides to give us a discount to keep it. Like if we ordered red t-shirts and they sent us blue, they'll say, well, we know we made a mistake, but how about if we discount it if you keep the blue ones? Okay, so those are purchase returns and allowances. And we can decide to do the allowance, or we can say, no, we don't want the blue t-shirts, and return them. Okay, and usually this happens with a debit memo. So the company will give us a debit memo, and that tells us how much we're going to be reduced by. Okay, so Net Solutions writes a debit memo to Maxim Systems. Okay, we debited your account for 10 servers, return 10 servers. Okay, so how do we record that? It looks like this. We reduce the accounts payable that we owe Maxim because we returned 10 servers, and we reduce the inventory because we no longer have those servers out on our shelves. Okay. All right, so May 2nd, Net Solutions purchased $5,000 of merchandise on account from Datalink. The terms are 210 net 30. Okay, so this is a quick little review here. So we go out and we buy some inventory from Delta Data. We increase our inventory with a debit by $5,000, and we increase the amount that we owe Delta Datalink by $5,000 as well. May 4th, we decide to return $3,000 of that merchandise. It was not what we wanted. Okay, so we reduce what we owe Delta Datalink, and we reduce our inventory. So now we owe Delta Datalink $2,000. Okay, the terms are still 210 net 30. So May 12th, we decide to pay our bill. So we're paying within that 10%. So we need to calculate our discount. Okay. And they don't show it here, but they show it in your book on page 218. Okay. So we're going to reduce accounts payable by the $2,000 balance. We're going to cut a check for $1,960. And we're going to reduce our inventory value by $4,000 because that's the by $40 because that's the amount of the discount that we took. All right, so now we can have some cash sales. What happens when we sell? That was just us buying merchandise to put on the shelves. Now we have merchandise out there on the shelves and we have customers who come in and buy it. Okay, so on March 3rd, Net Solutions sold $1,800 of merchandise for cash. Every time you have a sale as a company, you're going to have two entries. The first one is to record the sale, so we get cash of $1,800 and we increase our revenue by $1,800. The second entry is to reduce the inventory. Okay, so we are going to debit cost of merchandise sold, and this is like our expense account, remember. And we also credit merchandise inventory to reduce the value of the inventory that we have. Since it's no longer on the shelves, it's gone. So we got to reduce our inventory. So always remember, anytime you make a sale, you'll have two entries. Okay. Sale on account looks identical except for instead of debiting cash, we debit accounts receivable. Notice these are different, these values. Okay, the reason is we always sell it for more than we bought it for so that we can cover our other expenses and that we can make money. All right. All right, so we can also give our customers sales discounts. Just like we received a discount, we can in return give sales discounts, and those are those same credit terms that we talked about. Okay, so on March 19th, Net Solutions received the amount due within 10 days, so we reduced their amount by 2%. Okay, so we're going to receive a check in the mail from Digital Technologies of $17,640, and we're going to record the fact that they took a discount. So a discount is a normal debit balance, and then we're going to reduce their accounts receivable by the $18,000, the amount of the original invoice. Okay, and by doing that, we also issue them a credit memo, which you can see here. All right, so these will go through some more ideas for sales returns and allowances, which is the identical idea that we did for purchase returns and allowances. Okay, freight is another big topic to understand. Who's responsible for paying for freight? And freight is like UPS charges. Okay, so there's two ways that it can be written, the terms of the invoice, which will be FOB, or free on board to the shipping point, which means the shipping point is when the UPS picks it up. Okay, so if it's free on board to the shipping point, that means the minute it gets to the shipping point or the minute it gets to UPS, then the buyer is responsible. Okay, the other option is FOB, or free on board to the destination, and this means that the seller is responsible. Okay, so I would write these out so that you can keep them straight in your head. All right. All right, and this is the journal entries for paying for freight. And those are all in your book. All right, objective 3 describes the financial statements of a merchandising business, and the only real difference is to the income statement. The retained earnings statement and the balance sheet are done the same way. Okay, so for a merchandising business, we have a multi-step income statement. We first start out with our sales. Okay, we take away our returns and allowances and our discounts to come up with our net sales here. From that, we end up with subtracting cost of merchandise sold, which is next. See, largest expense that we have, to come up with our gross profit. From gross profit, we end up subtracting our operating expenses, and we separate them into selling and administrative expenses. Okay? And those are some very good examples, and those are listed next. From that, we add up our two operating expenses and we end up with total